Imagine waking up one morning, checking your investment account, and realizing your money has quietly, steadily grown without you having to trade, time the market, or study charts late at night. Sounds peaceful, right? But here's the twist. Two of the simplest investment tools, index funds and ETFs, are often misunderstood, even by people already investing in them. And that misunderstanding could be costing people money without them even realizing it. Today, we're diving deep into index funds versus ETFs, the pros, the cons, and the truths you absolutely need to know before you put another dollar into the market. If you've ever wondered which one is better, which one grows faster, which one costs less, or which one fits your life, you're in the perfect place. And trust me, by the end, you'll see these two investing giants in a whole new way. Let's start by setting the stage. Think of index funds and ETFs as two different kinds of vehicles that take you to the same destination. Broad market growth. One is like a reliable train. It leaves at scheduled times, moves in a predictable way, and you don't worry about the details. The other is more like a car. You get more flexibility, more control, and you can jump in or out at any moment, but you still end up traveling on the same highway. Now, the first big question. If they both track the same market, why does it even matter which one you choose? Well, that's exactly what most investors get wrong. Because the differences, tiny on the surface, can have a huge impact when you multiply them over years, decades, and thousands of dollars. Before we go deeper, let me ask you something. Do you think most people should prioritize convenience or flexibility when investing? Think about your own personality and your financial habits. Do you prefer simple set-it-and-forget-it tools, or do you like having full control? Drop your answer in the comments so we can see what most people think. Now let's pull back the curtain and look at index funds first. Index funds are basically big baskets of stocks designed to follow a specific market index, like the S&P 500, the NASDAQ 100, or the total stock market. When you invest in one, you're automatically buying a tiny piece of hundreds or thousands of companies. You don't need to pick winners. You don't need to time anything. You just ride the average growth of the market over time. The magic of index funds is simplicity. You buy them once per day, at the end of the trading day, at a single price. No stress, no second-by-second movement to worry about. For a lot of people, that alone makes them powerful. You get stability. You get routine. You get consistency. But there's a flip side. Index funds don't give you the flexibility to buy or sell instantly during the day. They're slow and predictable, like that reliable train. That's great for some people, but frustrating for others. If you're the kind of investor who likes to react quickly, or if your schedule only lets you trade during certain hours, index funds can feel limiting. Now let's shift gears to ETFs, exchange-traded funds. ETFs track the same indexes, own the same stocks, and aim for the same returns, but they act like regular stocks when it comes to buying and selling. You can trade them whenever the market is open. The price moves all day long. This gives you flexibility. It gives you control. And for many investors, that makes ETFs feel more modern and more accessible. Another big benefit: ETFs are often a little more tax efficient, especially in countries where capital gains on fund distributions matter. But the catch: that depends on where you live and how your government taxes investments. But here's something I really want you to think about. Do you believe having more control over your investments makes you a better investor, or a more emotional investor? Because flexibility is a double-edged sword. Some people love day trading their ETFs. Others accidentally sabotage their gains because they can't resist checking the price every few minutes. Tell me in the comments, do you think you'd use that freedom wisely, or would it tempt you into impulsive decisions? Now let's talk costs. Historically, index funds used to be slightly cheaper in terms of fees, but today, ETFs have caught up, sometimes even beating index funds in cost. Both are usually extremely cheap compared to actively managed mutual funds. But here's the hidden thing most people never notice. When you buy an ETF, you also deal with something called the bid-ask spread. It's small, sometimes tiny, but it's an extra cost you pay every time you trade. Index funds don't have that. So even if ETF fees are low, frequent traders pay more in spreads without even realizing it. If you're a long-term investor who almost never trades, this probably won't matter. But if you're constantly moving in and out, it adds up fast. Now let's tackle one of the biggest misunderstandings. People often think ETFs automatically perform better because they're more modern. But performance is tied to the index they track, not whether they're an ETF or index fund. Two funds tracking the same index will give almost identical returns. The difference? The experience of using them. So let's slow down and ask something important. If two tools give similar returns, which matters more, your behavior or the structure of the tool? Think carefully about that and tell me your answer in the comments. Because most financial experts agree, behavior beats product. If a certain investment structure reduces your stress and helps you stay consistent, that alone can make you significantly richer over time. Let's look at real-life scenarios to make this clearer. Imagine someone who contributes automatically every month from their paycheck and rarely checks their portfolio. For them, index funds are a dream. Automatic, silent, steady. Now imagine someone who likes the idea of investing but prefers to buy and sell throughout the day, maybe during their lunch break or right after work begins. For them, ETFs make more sense. The flexibility lines up with their lifestyle. But what about the emotional investor? The person who keeps checking prices, panicking at dips, and buying at peaks? For them, ETFs might actually be dangerous. The temptation to react is too high. Index funds might protect them from themselves. One size does not fit all, and this is where investors often fall into traps. They choose based on trends instead of personality. But real investing success comes from matching the tool to the human. Now I want to ask you something deeper. What kind of investor do you honestly think you are? Calm and steady or hands-on and reactive? Your answer may be the key to choosing between index funds and ETFs. Drop your honest instinct in the comments. Let's talk about taxes for a moment, but in simple language. Many countries treat index funds and ETFs the same, but others reward ETFs because of the way they handle share creation and redemption. That can lead to fewer taxable events. But here's the truth. Unless your country specifically gives ETFs an advantage, the tax difference might not matter at all. Now, before we keep going, if you're finding this video helpful so far, make sure you like this video, subscribe, and share it with someone who might be confused about where to invest. And tell me this. What was the biggest thing you misunderstood about index funds or ETFs before this video? I'd love to read your answers in the comments. Let's keep going deeper. Have you ever wondered which one is safer? The answer might surprise you. Neither is safer by nature. The safety comes from the index they track, not the wrapper they come in. For example, both an S&P 500 index fund and an S&P 500 ETF will rise and fall the same way. Your risk level comes from the companies inside the basket, not the basket's shape. Another question people ask, which one grows faster? Again, almost always identical. Growth comes from the index, not whether it's an ETF or a mutual fund. But here's a difference that really matters. ETFs work much better for people outside the US who want to invest internationally. They're easier to buy. They're available on more platforms. Index funds, on the other hand, are sometimes restricted by region. So think about where you live and how your country handles investing. Do you think investment access should be simple everywhere, or is it fair that people in different countries face different challenges? I genuinely want to hear your opinion. Leave it in the comments. Now let's talk about the psychological factor, because this is where most people lose money without realizing it. When your investment price changes second by second, it's natural to want to react. When it updates only once per day, it feels distant and calmer. This can change how you behave. So let me challenge you with a thought-provoking question. If the market dropped 20% today, would you feel more tempted to sell if you could watch the price fall in real time? Or if you only saw one price at the end of the day? Your honest answer reveals a lot about which investment is best for you. Now, as we start bringing all the pieces together, here's what you really need to take away. Index funds equals simple, stable, automatic. ETFs equals flexible, modern, accessible. Both equals great, low-cost ways to build wealth. But the best choice is the one that helps you personally invest consistently for years without emotional mistakes. That's the secret most financial educators don't emphasize enough. Before we wrap up, let me ask you the final big question. If you had to choose right now, index fund or ETF, which one do you feel aligns more with your personality and long-term goals? Post your answer in the comments.